Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. This is going to be a little bit different video than I normally make, where I'm analyzing individual stocks. I'm going to talk about how I would invest money if I received like a big lump sum of money, either from like leaving a job where you transfer your 401k out, inheritance, winning the lottery, maybe getting a big insurance payment, perhaps selling a home. So, anytime a person kind of gets a big lump sum of money, that's bigger than what they would normally ever expect to get, I've seen people have this happen. I've never had this happen to me yet. Unfortunately, I guess. But I've definitely seen other people kind of go through this. And if you're not used to kind of investing and handling money, it could be very kind of intimidating, I think, and very challenging. And even when I do a thought experiment to think, okay, what would I do? It's still pretty challenging, even though this is what investing in is what I do every single day. So as I was thinking about this, I thought I would make a little video where I just kind of explain what some of the biggest mistakes I think a person could make are, or the biggest risks, and then how I would go about trying to mitigate those risks while eventually trying to get that money invested in the market in the least risky, most reward way. So as always, this is not individual investing advice. And in fact, if a person did come across a big lump sum of money, they should talk to a financial advisor, and they could even run what I'm about to share by the financial advisor and see what they think. Okay, I just read this article in CNBC, which sort of spurred this a little bit, and they were talking about the number one ranked financial advisor in the country or something like that, and one of the quotes from them was that they don't pick individual stocks. And on one hand, as a person who kind of promotes learning how to invest in individual stocks, my initial reaction was a little cringy, but I also understand that, because I think if you're the number one financial advisor, you ought to know how to invest in individual stocks. I wouldn't expect like the average financial advisor, but they seemed like they were proud that they didn't know how to invest in individual stocks, or they refused to, or whatever. Which that is a little bit strange to me, but it does, I think, reinforce the truth that financial advisors are not really investors. It's more about managing your individual finances, and broadly kind of allocating money to different funds, based on general rules rather than actually knowing what you're doing, right? So the reason that a financial advisor wouldn't pick individual stocks is because they don't know what they're doing. Of course, if you're sending people into funds of stocks, they are buying stocks. They're just buying a bunch of them. So, and that's what most people are going to do. I think that's not the best way to do things. I think you should try to keep learning, which is kind of about what this video is a little bit about. So that kind of spurred me to make this video a little bit, because financial advisors serve a really important purpose, especially for people that don't know anything about investing and don't know, all the different ins and outs of things like Social Security and Medicare, and how much they roughly maybe need to save on average to get these ballpark kind of strategies. I think that's the purpose of a financial advisor. When it comes to actual investing, you need to have somebody who is a capital allocator, who knows what they're doing, or you need to learn it yourself, which is mostly what I advocate for. So you get all this money. I think the biggest risk, the five biggest risks are this. One, you invest the money in low quality businesses that ultimately lose money over the medium and long term. So that's one thing that you would want to avoid. I don't think that's actually the most common. I think the most immediate reaction when people get, if they don't run out and spend it and they actually want to save it and invest it, it's usually to conserve it, right? That's just my observation. People can write in the comments, and maybe if there are some financial advisors out there, they can write down what their experience is. But usually it's to preserve it. It seems to be the instinct of the people that are, not going out and buying, a Lamborghini or whatever. So the one thing is, the first thing, you don't want to invest in low quality businesses. The second is you don't want to pay too much for the high quality businesses, which is kind of where the market's at right now. It's dominated by a bunch of very high quality businesses for the most part. But people are paying a lot of money for the future earnings of those businesses, future potential earnings for those businesses. So that's a big mistake that can be made as well. A good example, the Nifty 50 in the late 60s. If you go back and look at those businesses, most of them are still around today, over 50 years later. But if an investor paid 1969 prices for them, they would have had 10 or 15 years where they made no money, even though the businesses were mostly good. So paying too much can be a mistake too, even if they're high quality businesses. The third issue, the third risk, is inflation. So for some reason, like, the people who are really worried about like hyperinflation, there's like those folks, and then there's people who don't really think about it at all, especially financial investors. I don't know how many times on Bloomberg every single day some bond manager comes on and tells everybody now's the time to be buying long-term treasuries or something like that every single day when the yields are like 3%, 3.5% or something. So inflation's in between 2 and 3%. So you're trying to get people a 1 or 2% real return over the next like decade or something, or 5 years, 10 years. I mean, yes, you can do that. But for one, you never know what inflation is going to be. So the same people were saying to buy bonds when they were yielding practically nothing, and then we had 20% inflation, and those people are still underwater in real terms. But it's kind of a stealthy loss of money. So if you get too conservative, you either make very little money, 1, 2, 3% a year, or you really lose it to inflation. And I think that might be the real biggest risk for a lot of people if they're just trying to be too safe and not lose the money that they, especially I think if they inherited it. Fourth are fees. Again, it's a bit of a catch-22 because if you don't really have a lot of experience investing, you obviously need some help. And you need some advisors and some to help get that money invested well. It's a little difficult because if you really don't know anything about investing, you're probably not going to be able to identify the people that can invest it well. So it's a tricky situation, and I think usually people just end up going with the averages, going with various funds that have shown, they do like 1 billion Monte Carlo simulations, and that seems to satisfy people, even though they don't even really know what they're buying. That's just kind of how it is, and I mean, I understand that. And then the fifth one is concentration risk. So you really need, if you have a method of investing that's pretty good, I think it's best to spread out those investments around. So any kind of unusual risk that comes along, if you only invest in 5 companies and one has let's say a financial scandal and the numbers all end up to be fake, and the other one gets disrupted by some new business that comes along, then you lose a ton of your money. You only have three businesses left that maybe can do okay, but overall you're not going to do well if you're too concentrated and you're wrong. Now, some people might be really talented, like Charlie Munger, and be able to invest in a handful of companies and really go all in on them. Although at the end of his life, he did invest in Alibaba and lose a lot of money. He said that was one of his biggest regrets. So even somebody as smart as Charlie Munger can make multi-million dollar mistakes. So I think not being overly concentrated is something you want to aim for to lower risk. So what would I do? Well, the simplest thing I would do is I would put half the money in an equal weighted S&P 500 ETF and half the money in a floating rate treasury ETF. So RSP for the S&P 500, TFLO, TFLO for the treasury money. And then every couple weeks or every month, I would take a part of that money and pick individual stocks and invest it. So let's say 2 to 2.5% a month, a couple percent a month, and then over 3, 4 to 5 years, that money would slowly get worked into individual stocks in the market. So what that does is if you're at the year 2000 or 2007 or 2006, is you're not putting all your money into stocks potentially near some gigantic peak all at once. It also gives you time to wait for deals in various parts of the market to come along. Sometimes the whole market might not fall, but there might be a part of the market that gets kind of cheap and you can find good deals over time. So slowly getting that money fully into stocks, I think, is the way to do it. But to take your time doing it. And I just launched a new service that kind of focuses on a weekly investment idea. And one of the ways I'm going to measure the results is this method that I'm using here to start off with this 50-50 portfolio. And when you buy a new stock each week, you take 1 week, you take it from RSP, the next week you take it from TFLO, and you see how the results go. So this would be like if I had a lump sum and I wanted to slowly buy individual stocks and learn how to invest in individual stocks along the way without making any big bets. So if we let's talk about what these are real quick. So this equal weight S&P 500 ETF basically takes an roughly equal amount of all 500 stocks. So what this does is it lessens concentration risk, which is really important right now because like 7 stocks or whatever make up like 20% or something of the S&P 500 and the other 4, it might even be more than that actually. I haven't looked at the amount yet, or recently. But so this basically spreads those bets around. So you're not too concentrated. So that was one of the risks. The second risk has to do with quality. Generally speaking, S&P 500 stocks are of higher quality than any other index that you're going to find. It's pretty much that simple. Now there are times where it's expensive. That now might be one of those times. That's why half the money is in basically cash treasuries. So let's look at the other half, which is TFLO. Now this could be like a high yield. A person could use a high yield savings account. If they're not in the U.S., they can't buy these ETFs anyway, or if they're in Europe anyway. You could look for alternatives, but you could also look for high yield savings or local currency treasuries if currency isn't like an issue, right? So this basically is our floating rate treasuries. The current yield, and you can trade in and out. One of the reasons I like this is if I need money, I can sell this and I can immediately go buy a stock with the money. So whenever a deal comes up, I can sell a little bit of this. This is where I put my cash that's meant for investing. The current 30-day yield is 5%, so that's well above inflation. But what you really want is this to be, over time, not lower than inflation, at least equal to or maybe a little bit higher than inflation. So, because inflation is one of those risks. You want something that yields enough without taking a bunch of risk so your money doesn't slowly degrade over time. So what this 5% yield does is basically protect that money against inflation. And that is falling right now because interest rates are coming down. Now the average duration is a little under a year for these, so they're relatively short term, but it will take, as the Fed lowers rates over time, if they keep doing it, there will be a delay for this yield to come down over time. So there's not really a rush. Now the timing isn't always perfect with what the Fed rates are, and because these are year-long treasuries on average, like they're spread out. But relatively short, very liquid, not really any risk. There might be a few basis points it could drop in a weird situation, but it would usually rise back up as these treasuries become mature, right? So, say 5% yield, basically. The cost on these are T-Flow is 0.15% is the fee, and for RSP, it's 0.2%. So there are fees, but they aren't super high. They're pretty reasonable for the service that you're being provided, in my opinion. So you have these 50-50 split. So how is it done in the past? So I went to Portfolio Visualizer and I set up a portfolio. This is like goes back 10 years. I think that's how far RSP goes, maybe slightly farther, but basically 10 years or so. And if you just were holding these, they would have returned 6.32% per year on average during that time, and 3.17% inflation adjusted. So remember, the idea with this money isn't to make a big profit. It's to not really make any mistakes while you're waiting to get your money into actual stocks. And I think a lot of advisors, investors on television, they'll promote like long-term bonds as like as an option. To me, like they're risky because of inflation, and the low returns that they're going to likely produce. Okay, so they have their own risk of really poor performance. Whereas if you can buy high quality businesses, if you have inflation, they can pass those costs on. So that's the benefit of owning high quality. But you have to learn which businesses are high quality. Usually it means they can grow earnings faster than inflation. And two, how much is a decent price to pay for those businesses. That has to do with like valuation. And those are just skills the person needs to learn along the way as they're investing this money into the market. But ultimately, being 100% stocks, unless you're getting ready to retire, is where I ultimately want to be. Now, I'm not there. I have like 30% cash right now in T-Flow, but I want to buy stocks with it. I'm waiting for those deals to come. So we can see that the drawdown here, so the return is pretty decent for being relatively safe from the worst of all the risks, right? The worst drawdown on a monthly basis was 13%. That's significantly less than the S&P 500 drawdown of 24%. And I think QQQ was down 32% in 2022. So, again, if QQQ falls 33% and you're pulling from your portfolio that's only down 13, you're buying things when they were much cheaper and getting a better deal. So when they recover, those stocks that you bought, which this actually happened to me in 2020 and 2022, those stocks you bought during the decline will produce really good returns when you come out, eventually recover. So that's kind of the idea there. But you can see much safer, beats inflation, and still produces like okay returns while you're trying to get your money in. Now, you can still lose money, but I think in a situation where the market falls 50%, you're probably only going to fall like 25%, which is a decent amount. But I mean, there's a risk you take for getting these returns, for getting the 6% a year. These are annual. These are not total return. This is 6% a year. So there's some risk that you take. Now, what I want to do is look at like real quickly, and then I'll be done here. I want to look at what these have done since the peak in January 2022. Okay. So, well, technically it was a peak. The S&P 500 is slightly recovered. But this is kind of picking what might end up being like a 2000 type top or a 2007 type top, or a 1968 or 9 type top. because once inflation is taken into account, so if you take the S&P 500 with inflation since 2022, it's only, and again, it's right at an all-time high pretty much right now. It's only returned 4% a year in real terms. The half cash, half equal weight is just barely positive, so you haven't lost any money. The drawdown, though, was less than 10% for the 50-50 portfolio compared to the 24, and this is monthly, so it was actually deeper than that, compared to the 24, so less than half. It was that much more stable. So, and this is kind of picking the worst spot to start, basically, the last peak. And so you get an idea of what, now we haven't had like a full recession yet. So if we have one of those, these numbers will all get worse. But I just want to show like relative to the S&P 500, this is kind of what it does during a really stagnation type period. And it still is at least positive. You haven't lost any money, even in real terms with inflation. And that's kind of what you want from a, and granted, this is a very simple, the simplicity is what makes it hard to do and to make a case for it. It almost seems like some sort of complicated formula with 10 different funds, that are all charging you fees that, or some sort of option, just all sort of these risk mitigation strategies that there's 10 billion funds, that can try to provide that you could just put your money in 2 ETFs and get pretty good diversification and risk mitigation on pretty much all these fronts for a relatively low fee. And so that's what I would aim for if I was in that situation. And that's what I plan to do, because you can't get all your money. Well, you can put it all in the market, but deals come around. Sometimes they can be really lumpy when it comes to buying stocks at good prices. But other times they can just kind of trickle in. I mean, this year we've had a pretty steady supply of stocks to buy. 2021 was much more difficult to find anything to buy in the first half of 2022. But then in the fall of 2022, there were quite a few deals. And in the summer of 2022, I found quite a few deals. So it can be really lumpy in terms of opportunity. And, if you put all your money in the market in January 2022, you've basically, you lost a quarter of it if it was in the S&P 500 immediately. If you had it in bonds, you would have done even worse. Actually, yeah, I wasn't gonna run a whole nother analysis, but you would have done even worse because we had inflation and it's eaten away at a lot of the real returns. So something to think about if this situation does happen to you, or you can talk to your financial advisor about it and see what they think. But I think this simple strategy is a place to allocate money before you start buying individual stocks in a steady way is a good approach. All right, thanks for watching. If you found this useful, hit the subscribe button, hit the like button, drop a comment. I usually answer all of them, and I'll see everybody later.